start with what we've talked about. So Maria, Tanya, and I chatted just a little bit, and we were like, okay, so what are we talking about? And like we just said a little bit ago, this is a huge topic. It's super broad. We could spend hours upon hours. Many books have been written about it. And yet we want this to be helpful for everybody that's tuned in and for those people that come later. And so we're thinking of starting really kind of our plan for starting was a question where I want to ask Maria, I want to ask Tanya, where they started in real estate. What was your financial system that you were using? How did you pick that? Maybe you didn't have one. And so it's kind of starting from that point, but why don't you just tell us a little bit in case people don't know who you are, what you're doing currently, and then we'll jump into that. So I don't know, Tanya, you want to go first, and then Maria, you can go second?
Sure, I'll go first. My name is Tanya Powell-May. I am the CEO and rainmaker for the Legacy Homes GR team at Keller Williams North. I am also a CPA, been a CPA for about 30 years. I got back into real estate full-time in 2015, but my sister and I were dabbling as a team when we graduated from college. We were working for a brokerage called Pearson Cook that's no longer around, as a team way back in the mid-1990s. Then we both got married and had kids and decided we were just to stick to one job and family. So, but I got back into real estate full-time in 2015, started my team in 2016. There are now 9 of us. I just love real estate. When I started, I had the luxury of having the accounting background. So I knew better than doing nothing. I had experience working with other clients using QuickBooks. So that's what I adopted right away, using QuickBooks for my business.
Awesome. Awesome. And are you currently using QuickBooks, or have you moved on to something else?
No, I'm still using QuickBooks.
Okay.
Every month.
Excellent.
Yep. Mm-hmm. And doing it myself. Some people contract it out to have someone else do it, like a team like Jim Glenn. They use a company called, I think they're Streamline Services. Maybe another company in our office uses them, but they charge a monthly fee to create their financial statements every month.
Awesome.
But that's the primary system I use. I use QuickBooks to track. They have a self-employed app that you can use to track your mileage, which is pretty convenient. You just swipe to classify it as a business or a personal drive. And then I use QuickBooks to track my activity every month.
Nice. Maria, how about you? Tell us a little about yourself and your background, and then when you got started in real estate, what system were you using or not using?
So my background is in finance. Out of college, I worked as an investment advisor, so focused on wealth building. I took a little break from that to open a bakery, but that's a side note, which brought me back to Grand Rapids. And then when that didn't take off, I kind of went back to my roots in finance, and real estate was a natural kind of place to enter back into the workforce. So I'm on the Boss Lady Realty team. So I work with Sherry Smith. She's our team lead and rainmaker. So my expenses and my taxes are a lot easier because, you know, most of those expenses are passed over to the team. I don't have to worry about that as much as like Tanya does running a large team. But like Tanya, I also use QuickBooks self-employed, and like Tanya, I knew what it was coming from a background of having pay that goes like this, or commission-based pay, how you really have to be diligent and purposeful when you have money coming in, how you're spending that money and how you're saving it for lean times. So I use the QuickBooks self-employed. It's super easy. I always tell everyone, like, just use it. You know, it is a deduction. and you swipe right and you swipe left. So I call it like Tinder. I'm like, it's like Tinder for your expenses. You know, it's really like, if you can't do that, then you're going to need to hire someone like she was saying, other agents do. So,
Right. So this is an app you ladies have on your phone
yeah.
that you use.
Yeah,
And
I have
I file my own taxes too. And so throughout the year, you know, when I'm logging my mileage and I'm logging expenses because it syncs up to all my bank accounts, as I'm logging them as business or personal expenses, it's also identifying what category they go in. So then when I go to file my taxes, 95% of the work is done. It's really just looking back over the year and making sure what I did is correct throughout the year.
Mhm.
Awesome.
Yeah, and I have it on my phone, an app on my phone, and then I have a cloud-based version of QuickBooks on my computer, so I can look at it that way as well.
Yeah.
So it sounds like the gist of it is where you're spending your money. Is that correct? And so when you spend money, you know, categorizing it as either a business expense or a personal expense, are your accounts set up where it's separated, where you have personal accounts and business accounts, or are you strictly working out of one system and you have to designate that for everything?
I have multiple bank accounts depending on the use. So I have, you know, a savings account that holds what my tax liability is going to be. I have a housing account. We have a debt payment account, and then for my business accounts, they are business accounts at the bank. And I have one that I call my cost of doing business. So I know that I need to fund that first. And then I have another that's a business spend. So for example, I know I need to fund my costs of doing business is going to be things like my office fees, right? I need to make sure that I'm going to have money in that account to pay those and my cell phone bill. But my business spend account, well, not in 2020, but like in 2019 or hopefully this year would be like networking events, drinks, buying people coffee, buying people dinner, things that if I had to tighten up, if I had, you know, a bad quarter or a bad month, I could release those and I keep that money separate.
Okay. How about you, Tanya?
Those are good points. So one of the things that I advise my agents on my team is to open a separate account for your business expenses. Don't commingle your business expenses with your personal expenses, because you create a nightmare when you're trying to figure out and go back and figure out what's what. So if at all possible, using one account for business expenses is what I usually suggest that people do. Also, in terms of the categories, I use in the back of the MREA, Millionaire Real Estate book, there is a recommended chart of accounts that they recommend for us to use, like in terms of categorizing certain things. And I should have that right here in front of me, but I'll find it. But you want to be able to categorize your expenses, whether they're telephone and communication expenses, your photography expenses usually go in cost of sales, signage, transportation, just the different types of fees that we have as real estate agents. They have a nice, easy to follow chart of accounts that I really try to use in QuickBooks to track the type of expense that there is. But the suggestion that I have in this area is to just try to separate your personal account from your business account and use your one or two accounts for your business. And to Maria's point, one of the big problem areas or pitfalls or things that I had to do or realize when I got back into the business is that, you know, we get great commission checks sometimes, but if you're not planning for taxes at the end of the year, you're going to have a problem, right? Mm-hmm. So I've seen people do different things.
We call those deficits, right? Is that what those are? Yeah. Deficits?
Yeah.
Well, here comes the IRS.
That's right. Tax man comes calling.
Yeah.
Exactly. So separating that money, like every commission check that you make, a certain percentage, whatever you decide that is based on your tax history. I've heard people do 25%. I've heard people do a third, it just depends. That money needs to be set aside in a separate account for your tax liability because you will have a tax liability if you're getting commission checks without any
Right.
tax reporting.
And the other thing that people forget sometimes about putting money in that account is that's exactly what a W-2 employee is doing when they get a refund. So if, like Tanya said, someone puts a third of their check in there, but they only needed 25%, well, after they file their taxes, they get a return, right? I mean, granted, the return was always in their bank account, but they still can get a return. And some banks do offer higher interest accounts or CDs that you can buy to sock your tax money away, what your tax burden is going to be, and you can have that be invested. It's not a lot. I mean, you're not getting like 10% or anything, but it also keeps your fingers out of it too. So
Yeah, it's I think who was it? Allison was asking about taxes, and so it sounds like most people just take a percentage right off the top of your whatever your commission check is that you net and put that in there. So Maria, for you, what is that percentage you typically put into a tax account?
I do 20%. So
Okay.
I'm pretty risk adverse, so I like to have a little buffer in there, but I also claim a lot. So my adjusted gross income is pretty low.
Okay. How about you, Tanya? What do you typically allocate?
Usually a minimum of 25%.
Okay.
Because I want to have enough in there to cover my federal and state tax liability. So I write off quite a bit too, but I just don't like writing the IRS a big check. So I'd rather not do that. So,
and some of us are W-2 employees. I know I am. Kendall, I imagine you are too. And so this year I had some real estate deals on my own where I set up a little bit each time that went into a tax account, and it definitely helped at that point in time. And guess what? If you have more in there than you need, you either have a head start for next year, or you can use that for something else. You can reallocate. So
right.
it's kind of a fun thing to watch there as well. I'm fortunate. I'm married. I have kids. I have lots of different ways that I can take my taxes down. And so I didn't have to pay anything in for my federal taxes. In fact, I got a healthy refund this year. But that's for my situation. I think it's important. Each person knows what their own situation is when it comes to doing these things, right? So if you have lots of write-offs and expenses, I imagine both of you have them. What are some of the categories that you keep track of, or that Quicken helps you keep track of, that maybe if an agent hasn't set up a plan like that, they should definitely start keeping track of those expenses to help with their taxes?
Right. I'll share. I did last year. I offered a checklist of tax deductions for real estate agents, and I'll share that again with Chanel just to pose to
Nice.
share with the office, just so that they know. But vehicle mileage, that's a big one. This year was weird because we weren't driving as much as we normally do. But still, that can be a pretty sizable deduction that people can take. But you need to track it. If you're ever audited and you can't substantiate what deduction you're taking, that's going to be a problem. So at least use a tool to track your mileage. I don't know if the office still offers that. There was one that the office offered.
Was it Mileage IQ or?
That's a good one too.
There's something else I thought it started with a P. I can't remember.
That's probably the most popular one.
I use Hurdler.
Hurdler?
Yeah, it's very simple too. It's kind of like Tinder, like you were saying, Maria. You just swipe right for business, left for personal.
Yeah. That may be the one that the office was offering. So vehicle mileage, if you buy or lease a new car, you can deduct the lease payments and the depreciation on your vehicle purchase. Your home office deduction, you get to deduct a portion of your rent, utilities based on the space you use for your business. Any software or apps that you use, if you're using QuickBooks or Mileage IQ or Curdler or whatever you're using, you can deduct those expenses. Your cell phones and your tablets that you use for your business. Your office supplies. If you use virtual assistants or bookkeepers, you can deduct the expense of that. Your office rent, office equipment and supplies, internet and phone costs, marketing and advertising. Beware of like giving gift cards to your client. There's a $25 max deduction really in terms of what the IRS says that you're allowed to do in terms of those types of things. So I've in the past done the Cutco knives because if you brand your name or something like that, you can consider it an advertising cost. So marketing and advertising, travel, we're not doing a lot of that these days. Conventions and conferences, we're not doing a lot of that. Client meals, you can deduct 50% of the meals or entertainment with clients. Again, the client gift maximum is $25 per client, and I know a lot of us do more than that. So if you can somehow brand yourself on your gift, that makes it a marketing expense. Contributions to retirement plans are tax deductible. Your desk fees are deductible. Your CE, that's deductible. Your annual dues and your membership fees, those are deductible. Anything you pay for insurance, legal and professional, and interest on any business loans that you take out. That's what's included on the list that I'm going to provide, Chanel. So those are the things that I would encourage you all to consider.
Yeah, Allison had a question there in the chat. She asked about the car lease payment or, a car payment. Is it prorated on business mileage? Is there a limit on those things? Do you know?
Yeah, so my vehicle is a business vehicle, and it's used probably 75% used by my business. So 75% of my payment gets charged to my business.
Okay, and that would be the same with insurance and other costs on your car as well, right? Okay.
Yeah.
Nice. Maria, anything else that jumps out at you as far as deductions and things like that? I think one that I was thinking of was, and Tanya mentioned this, but not necessarily specifically, your GRAR, MAR, and NAR fees, right? You're going to pay those every year, so make sure you're keeping track of those and
Yeah,
those off as
well,
well.
our dues at the office, our board dues, I think she said continuing education classes and things like that.
So one thing I've noticed helping clients is my self-employed people. Some of them are, how do I say this? Income poor when it comes time to try to get a mortgage or things like that, where they've taken their expenses and they've written off enough of their income that it's showing so little that they aren't qualifying for a mortgage or things of that nature. Any ideas on how to prevent that or what to do? Because I know none of us like to pay the government any more money than we need to. But at the same time, we want to be able to buy a house if we wanted to, or an investment property or things like that. What are your thoughts on those things, ladies?
Some lenders will look at, they won't have to look at your tax returns. They can look at the income that you have coming in through the business, which is pretty common. You just have to find the right lender. You're probably not going to walk into a large institution and have, the loan officer sitting across from you decide to get real creative. But if you work with lenders, and I've seen some chatter in GRAR where people ask for suggestions for this type of stuff, but they're definitely out there,
Profit and loss, right? They're usually asking for a P&L, a profit and loss sheet for each month.
Yeah, most banks are going to ask for 2 years tax return. So you have to plan for it. Like I might take a hit. I mean, you need to write off everything that you are supposed, your you're eligible to write off, right? In most cases, but you know, if you know that you're going to make a purchase like that, if you're going to buy a mortgage, you know, you might defer or not take a big deduction that you could take just because you know you need to show a certain amount of income. So it's kind of like, I wouldn't say it's a game, but if you know that that's your ultimate goal, you got to set aside some money to pay maybe a little bit more tax than you would to show the kind of income that you'll need to have to buy what you want to buy. So I've done that. Like, man, I could have wrote this off, but I'm not going to because I want this mortgage, right?
Yeah, no, that makes sense. So sometimes it sounds like, you know, having the number in mind of what you want to show. And so some of that comes to pre-planning, right? Having a conversation with a loan officer to say, okay, what type of income do I need to be able to have a payment around here? And
Right.
so, yeah, no, that makes perfect sense.
Yeah.
So that sounds like planning, right? Which some of us are good at, some of us are not so good at. What are some of the current goals that you guys are working on when it comes to your finances, if you don't mind sharing those? And you know, you don't have to be super specific about it, but how do you determine those goals, and where are you at? How do you hold yourself accountable to those things?
Well, a few years ago, my significant other and I, when I first got into real estate, we put together a pretty inclusive debt reduction plan. We weren't too bad, you know. We weren't. I don't want to make it sound like I'm strat or anything, but we had some stuff. We had like windows, we had car payments, we had a little bit of credit cards, we had a camper. You know what I mean? We had some things, and then plus a couple properties have mortgages on it. So I followed the Dave Ramsey, and I can try to find the link, but I know that the calculator is very readily available, where you can plug in your debt obligations, and then you can get the snowball method, which I really like. I like leveraging properties, so we don't really have like a mortgage-free goal necessarily. We have more of a get more properties goal. But getting rid of the car payments and the windows and all that stuff has made a huge difference, tremendously. I mean, the amount of debt can sometimes add up to a new mortgage payment on another investment property. So it can hold you back. So that's always like step one for me. What I recommend to people is get rid of the unsecured stuff, get rid of the lingering, see what this administration is going to do with student loans. And if they don't do anything in the next couple of years, then, you know, get rid of them. It might hurt. You might not be able to go on vacation, but get rid of it.
Mm-hmm.
How about you, Tanya?
Yeah. For me, it's a cash flow game, right? Because I lead a team. So it's making sure that I have the cash resources to do what I need to do. When I first got into this business, I was not prepared for the up and down and the up and down nature of the being commission only. And because my lifestyle was at the middle, right? And sometimes, you know, I wasn't prepared for the peaks and valleys. So I was using the e-commissions and doing all that when I first got into the business just to keep, because I have a good, I'm going to pay my bills on time, right? So I did that. But when I look back to see how much that cost me, it was like, that was just ridiculous. Like, that was like, don't ever get in that position again where you are giving up 10% of your commission just to pay your bills on time. That's not wisdom. Wisdom is making sure that you have the cash reserves that you need to have to be prepared for the valleys, because we will have peaks and valleys in this business. And then also living on a budget as much as possible, because sometimes we make so much money. Sometimes it's like, oh, I'm fine, I don't need to. But when you don't live on a budget, you can very easily spend $1,000. This is personal, eating out in a month. You know what I'm saying? And you're like, you know what I could have done with that money, right? So just getting back to the basics, living on a budget, you get to set the budget as what you want it to be. It doesn't have to be a rice and beans, Dave Ramsey budget. you get to set it how you want to set it. But once you set it, do your best to live on it so that in the future you can do the things that you want to do. So for me personally, my big why and my vision revolves around my family and being able to be available for my family. So my 5-year plan is to be able to retire or partially retire. So I am working hard over the next 5 years to build a portfolio, to build my net worth so that when I retire, and I'm finding it in 5 years, that I can live a comfortable lifestyle. So that means I need to be putting away a certain amount of money consistently each year for retirement. I need to be buying investment properties like Maria mentioned to build that passive cash flow stream. I need to be looking at the different revenue streams that I have to figure out how to build them up. I'm sorry. One of the things I like about Keller Williams, like I have title shares and we have profit share and I get commission. And like I said, I have to add the passive income being burned, getting back into investing in real estate, in the accounting stuff that I do. So I have some revenue streams. It's just building them up and shoring them up so that 5 years from now, I have the network that I need to live comfortably.
So I'm gonna back us up just a little bit. You said some different terms in there, Tanya, that I'm familiar with, and so I love reading books about financing, personal wealth, all these things. Dave Ramsey, I've read his stuff. Profit First, another great book. You know, Richard Kiyosaki, Rich Dad Poor Dad, and so you hear cash flow, you hear passive income, you hear revenue streams, and so passive income, for those of you that don't know, and I don't want to assume that nobody knows this or that they all know it, is money that comes in when you're not actively working, right? So the best one example I can think of is a rent that's coming in, right? After you pay the expense of the mortgage, if there's a mortgage, the taxes, those type of things, property manager, whoever you've got doing it, what's that portion of money that comes to you that you can now use discretionarily, right? So that's a passive income. Income streams, where's it coming from? Is it your commissions? Is it your profit share, like Tanya brought up there? Is it any other thing? I'm a dad of 2 adopted kids. I get an adoption subsidy every month. That's a passive income. Yes, it goes out to pay for all the things that those kids need, but it comes in every month. I can count on it to be there. I feel like I'm knowledgeable about many strategies, but where it breaks down for me isn't putting together a budget, isn't figuring out the pluses and the minuses, it's the sticking to it. How do you ladies stick to your plan? What do you do? What are some of the ways that you make it easier to stick to it?
It's always in front of me. I mean, it sounds silly, but I used to pew people who would do vision boards and write stuff down and all that stuff, but you have to have it like in front of you. Here's how we're growing our net worth. Here are all the things, right? This is what's feeding my family and what's going to feed our future. And it's always, right up there on a magnet board. So that's one way to stick to it. Because when you get, oh, there she goes. Tanya's is a little cuter than me. Mine's kind of boring.
Tanya one got hers in seconds. No, you know what? And I think about that. How many of us are working on like a 66-day challenge when it's up right where you're looking and things like that? It's much easier to think about it. So how often do you visit your money? How often do you visit your accounts to know that? How does that play into what you're doing?
I visit mine almost every single day. I mean, I'm just going to be very honest. I have a very detailed household and business budget. I mean, I'm not, playing with it every day, but I open my app and I look what's in my bank accounts every single day to make sure we're on track. I use a program to make sure that I'm following my budget. It's Every Penny, I think is what it's called. This is for household. This isn't for every dollar. Yeah. So, and that makes sure that that we're staying on track. I mean, we have vacation goals and fun goals, and it's not just about groceries and paying the bills all the time. But I just want to make sure that, we're going to go to Key West, we're going to go to Chicago, we're going to take these trips and save for them. So every dollar, not every penny, but every dollar, I would say I jump in there like once a month. And in my bank accounts, I look at those every day just to make sure we're on track. So that's how I do it.
So is a lot of that based on allocation? So you get your commission check and so much goes to here, or how does that break down when you get each commission check?
So I have just a little, it's on a spreadsheet, it's an Excel spreadsheet, right? And it just says this percent goes into each of these accounts. And that's just based on how I spend, household or business accounts. So if my commission check is, dollars and cents, and whether it's, 10,000 or 1,000, right? Our commission checks vary quite a bit. I know that a percent of every dollar I get has a place that it needs to go. And that's
Nice.
how I do it.
How about you, Tanya?
I got distracted. I use my vision board and I visit my bank accounts honestly every day, but not like detail, just a kind of quick glance. But probably in it more detail every week, and then the most detail at the end of the month when I'm doing financial report, and figuring out where we are. So just to see if I'm on track or off track. So for me, it's a daily, probably quick glance, but weekly I'm managing it, and then monthly, just really the deep dive. Okay, what's coming up? What can I put away for different things, and going from there.
Yeah, I was looking at the chats here, and Allison asked another question, and I'm going to try to ask it or answer it a little bit and get your opinion, ladies, on it. So she asked about taking out a home equity loan, if it's worth it or not. And I guess there's two different ways of looking at this. One, what's it going to do to your cash flow? If taking out that home equity loan is going to help your cash flow, and that's the most important thing to you, then it might be a good idea to do that. The second thing is, what's it going to cost you over a length of time? And so if it's going to lower your net worth, then it might not be worth it to do that. And so you have to look at interest rates of what your loans are, or your payments that you're trying to take off, but also the total payments. And so for me right now, a lot of what I focus on is my monthly cash flow. What's coming in that's discretionary for me that I can allocate to where I want to. And what about you ladies? What would you say as far as using the equity in your house to pay off some debts, or to use that for other things?
I'd love to hear what Allison had in mind. If she could unmute, like what were you thinking?
Yeah, Allison, what were you thinking?
I
What were
was-
you thinking? No,
I was actually wondering about refinancing a mortgage on a house, not getting a home equity line.
got you. Okay, so in refinancing.
Yeah.
So
Oh,
let's talk
is
about.
there-
Oh,
go ahead, Tanya.
no, go ahead. What's your interest rate currently?
So I'm at 3.875.
And you tend to stay in your house for a while?
At least another 5 more years, I would say.
So you have to, in whatever lender that you're chatting with, just make sure they're a good one, but you have to look at the numbers, because there's a cost associated with refinancing.
Right.
And that cost, you have to be able to recoup that cost on what you're saving in interest. And also keep in mind, if you're refinancing back into another 30 years, and I don't know how much you have paid off on your loan, but you're going to pay a certain amount of interest, right? Regardless if you refinance or if you don't refinance. And if you refinance, you're going to have closing costs associated with that, and potentially tack on more years to your mortgage.
Right.
So you have to look at those numbers, and you have to be able to talk to, whatever lender or loan officer that you're working with to see if it financially makes sense to you.
Mm-hmm.
And then, I know a lot of people who like to refinance down from their 30 to their 15, because they're going to stay in the home for another 15 years, 15, 20, 30 years. So in that case, it makes a lot more sense. Their monthly payment stays the same. but they just dropped 5-8 years off their mortgage. If you're going to move in 5 years, that might not make the most sense for you. But I would you have to look at the numbers, see if they make sense.
Is there like a time, amount of time where you should recoup the cost on refinancing?
Well, if you're going to move in 5 years, it's going to have to be definitely within that 5 years. So
Okay.
if it costs you more to refinance than what you would make up for in interest in 5 years, then it's a bad idea.
Okay.
I think personally.
Okay.
And,
Just
and
curious.
that's from an end goal, right? How much money did it cost me over this period of time? If
Right.
you're looking at monthly flow, so let's say your cash flow right now per month is only $100, and you could increase it to $200 by lowering your payment by 100. That's
Right.
something to consider too. And I'm not saying Maria's wrong. She's definitely right on what she's saying, but that's where it really depends on your goal. What are you trying to accomplish? Is it
Right.
changing your monthly cash flow?
Yes.
Is it changing your long-term investment? And if we're paying $300,000 for $100,000 house, that's a lot of money. But if Jeff Anderson told me if I've got somebody else paying that mortgage for me on an investment property, well, that's totally different than if I don't. So, Tanya, what were your thoughts?
I was gonna say the same thing as Maria. Like usually anybody that's over like 4.5 right now, 5%, I'm like no brainer refi, because you can get 2 something. I can't remember what it was a few weeks ago. It was like 2.5 or something low. But that interest rate, and especially too, I will just tell, it depends on your financial picture too, because some people are paying high credit card interest. Like they haven't paid off credit cards and they're paying 20% on a credit card. And, for some of those people, I'm like, go ahead and refinance and get rid of that high interest debt and just pay more on your mortgage to get it down. Just because it just hurts my heart when I hear, when people are paying 20, because I've been there, have to pay that amount of interest on a credit card or unsecured debt. So you want to get rid of that. If you're using the money to buy, and then you mentioned home equity, so let's go back to that. I've seen some people use the equity in their home to buy investment properties. And in my mind, that's not necessarily a bad strategy because you're buying an appreciating asset, right? And the interest on home equity lines of credit are usually pretty low, and keep your cash, right? And so that's a strategy that I've seen people use to go out and secure.
And taking the time to investigate what products are out there that you can use. Some are going to be very expensive for you to refinance. Like the cost is, $5,000 to $9,000 on a refinance, where Keller Mortgage is working really hard to keep it really low and sometimes can give you $1,000 back if it's over $150,000 that you're refinancing. And so you have to know your products too. And one product might make a lot more sense than another product would. So I think that your situation definitely matters and what your goal is, what you're trying to accomplish. And then also, who are you talking to? Just because you're using somebody now, they may not be the best person for you to be linked to financially for the next 15 or 30 years. So.
Okay, thank you all very much.
Yeah, I actually refinanced with Keller Mortgage last year because of the $1,000 back in credit, and their interest rates were super competitive. So yeah, we should take advantage of checking into Keller Mortgage.
Great.
What they offer.
Anybody else have any questions for either of our two panelists here?
Yeah, I do. I'm in the process of building out a team, and I've done a bunch of research on whether to do an S corp or an LLC. And I guess I'm just confused on, is there a simple answer on how they work, or is there an obvious answer of how I should set it up, or just curious how that works.
Right. So I have my legacy home is set up as an LLC, and also I have an S corp designation. So the W-2 wages that I pay, because I give myself a paycheck to my business as an S corp, I get to write that off and not pay the self-employment tax that we normally pay. You know, Dan, if you weren't an S corp. So that significantly reduced my tax liability last year. I did it for the first time last year, and I was like, wow, why didn't I do that before? So it was significant.
Do you think that was something, Tanya, that you should have had set up immediately as you were building a team, or maybe a couple of years into building a team? What's the timing on that as you look back at your team and where it is now?
Sooner wouldn't have hurt, but you know, like I said, when I hired Parker on as my director of operations, I had an employee, right? So then I was using a payroll service to do payroll anyway. And I'm like, okay, let's start paying myself a salary this way to reduce, since I'm an S corp, to reduce my tax liability. I didn't really realize how significant it was. I think I want to say it was like year to year, it was like 30 to 40% below what I paid the year before. So that was significant.
So your income, your net income increased by 40%.
Yeah, that in terms of the tax liability went down from year to year, and compensation, my earnings, my GCI was pretty consistent year to year.
Right. Wow, that's huge.
Okay, so the Wiser Group would be an LLC, and then I would have a S corp within the LLC to pay myself a monthly salary, essentially.
Yeah,
is what you're saying. Okay, cool. Are those documents that I can fill out, or should I have a CPA fill them out?
I can help you do that, Josh.
Okay.
But 2556, I think is the form to select an S corp designation. You have to file your articles of incorporation for your business with the state. Have you done that yet?
No.
Okay.
I need to do it ASAP.
You'll have to get a tax ID number from the IRS, and after you incorporated with the state, and then do that S election. So I can help you with that. Just don't let it get months down the road and we haven't done it.
You got to do it by March.
I was just going to say, this is the reason why you do these classes. You teach these classes, and then you might pick up a client that needs to set up an S corp or an LLC, right? So nice.
Yes.
And if you're going to set up the S corp and the L, and all that stuff, you probably do want to have I mean, whether or not, Tanya wants to have you as a client or not, but you'll want to have a CPA filing your taxes, because it is a little bit more than just if you're an LLC and you're swiping left and swiping right. I mean, when it comes down to it, there's just a little bit more.
Okay, thanks for that input.
Yeah, because for me, with being on the team, and I don't have any W-2 employees or anything, and I did have a CPA set me up an S corp and go through all of that, and then what I found is that it wasn't saving me more money. It was costing me more time, if that makes sense. Like the time, just because, again, I don't run a team. I don't have a business. I'm not paying any W-2 employees or anything. So for me, it was much simpler just to have my my business expenses, income versus expense. So, but it sounds like what you want to do, Josh, you'll want to have it more set up like Tanya's, where it makes more sense for her.
Okay, thank you.
You can also pay yourself a W-2, like, do you know what I'm saying?
Yeah, I do.
And you'll save money.
Well, she charged me a lot of money.
I'm not saying that I want to do it. I don't have time. Really.
Yeah, I know you don't.
My family, so.
No, that's awesome.
Right.
Any other questions anybody has for Tanya or Maria?
I have a question for Maria. Can you talk a little, because you have an investment background, can you talk about like some investment opportunities or things that we should be thinking about?
Well, I always tell people, like, I mean, real estate is the foundation of wealth. I mean, it really is. You know, you got to own your property, and then you can buy rentals and have income coming from there. And then you can think about the stocks, the bonds, and mutual funds, and all the Bitcoin, all those other things. Um, but you really have to start with real estate. I mean, it all starts with real estate, owning your own property and owning other properties. Um, for me, I always make contributions to IRAs. So anyone who's not, you should start. The maximum I think is 6,000 or 6,500. I can't remember, Tanya. I'm blanking on it.
6,000. It's 6,000.
6,000. So even if you don't have the 6,000 to contribute, you can still put $100 in your IRA, or you can allocate, if you know what your goals are going to be at the end of the year, you can take a percentage of, this is my income from the year, and it works just like someone's 401k account. You can take a little bit out of each commission check and fund your IRA. The tax savings are great. You shouldn't be just throwing that money away and giving it to the IRS, right? And then once you are in an IRA, I've attended a lot of classes where people get really creative of how to buy property within it and how to leverage it. And that's really great. But if you're just, kind of starting out and you're busy building your business, then what you should really do is just buy mutual funds. I mean, it just really is, because mutual funds, it's a money manager running it. It's a basket of stocks and bonds and other types of investment. And you can just click it, buy the mutual fund, and kind of walk away. And a lot of the mutual fund companies they're targeted towards your retirement date. So you can buy a mutual fund that's like mutual fund, 20 years, meaning I'm going to retire in 20 years. So the way that the manager is running that fund is geared towards my retirement and keeping my investments safe. Is that the kind of, I don't know if that was too quick. I didn't want to.
But I would just point out, if you've read any of the Rich Dad Poor Dad series, and you talk to Robert Kiyosaki and what he says, he's constantly looking to add to his passive income. But if you listen to what he says, the putting money in a stock market, it's stupid not to if you're getting matched to do it, right? But also, if you're looking at an IRA here, the tax saving on it is huge as far as the money that you're putting in there when you're bringing it back out or when you're putting it in. And so, again, those are just, they're easy ways to set that up, and you don't have to think about it.
Yeah, and one thing I want to say that sometimes I just hear the mistake that some people make. They say, well, I'm going to buy stocks, or I'm going to buy mutual funds. And they do that outside of a retirement account. And they think they're doing the right thing. And, they may see it grow, right? If you would have bought stocks 10 years ago, you'll have more money now. If you buy them today, you'll have more money in 10 years. That's the way the market works. The problem is you're paying taxes on all that income. And if you are putting money in the IRA account, you're saving money from what the IRS is taking year over year. And then the wealth that you build within that IRA account isn't taxable until you take it out. And it's a great vehicle. It's there for American citizens. I mean, it's put to help us build wealth and to help us have money when we retire, so that we're not a burden on society, I guess. But don't just buy stocks. I mean, I hear and see people do it all the time, and it just makes me cringe, because that's great. You bought some Apple stock, but now when you turn around and sell it, you're going to get robbed of your investment and paying taxes on it. If you had put it into an IRA account, it's tax sheltered until you retire. So that's kind of the most important thing. The other thing I would say is, if you have $1,000 to invest, don't buy one stock. That's the other mistake that I hear a lot of people make. And it's really frivolous and very silly, but it's the way that people talk. When I was at Morgan Stanley, we used to call them Dunkin' Donuts investors, because it would be people who would sit around coffee and donuts and talk about what stocks they were going to buy, rather than having a plan, doing the research, and sticking to it, right? They would just talk about, hey, Tesla's doing good this week, I'm gonna buy some Tesla stock, And that's where mutual funds can help protect your money, right? Because if you have, does everybody know what a mutual fund is? I don't, anyways. So if you can put that $1,000 into a mutual fund, then if Apple has a bad day or if Tesla has a bad day, it doesn't hurt you as bad. If the Dow has a bad day, I saw some pretty bad days, but my mutual funds held their value. I mean, you don't see low lows and you don't see as much of highs. And then in terms of wealth building and to what I said about property, you don't want to, stock all of your savings into the stock market. That doesn't really feel good either. What I'm really passionate about is leveraging and buying investment property, and then using, since I don't have a 401k, right? We don't, I'm saving my money, using my renters, the money that I get from my renters that pays the mortgage, and then the income can be saved to use to buy another property, or it can be used to put into my IRA account, right? And to build my retirement off income that I got from my renters.
So, Maria, I've heard of different types of accounts where you can actually own properties within your account, and you can have the rent go back into that account. You can buy more properties within that account. Is your IRA set up that way? Is that a different type of account?
No, it feels a little laborious for where I'm at in my stage of life to do that. And I don't think Jeff is still on here, but I took one of the classes that he taught about tax advantages to rental properties. And there's so many. I mean,
Right.
it was an amazing. I think you were in there too, Kurt. It was
Yeah.
It was a really amazing class.
I think
But
Jeff
there's
just
so-
unmuted, so I
Okay.
think he's here.
Yeah, there's so many tax
Yeah.
advantages to rental income. What? I'm sorry.
Yeah, it's time for Jeff to do that class again.
Yeah,
Absolutely.
it was amazing.
Yeah.
That was really good. But I mean, to his point, there's so many great tax advantages to property that I don't necessarily know why you would stick them in a tax deferred account. Plus, you can only put a certain amount of money into a tax deferred account. So if you don't have the money to leverage to buy another property, you're kind of limited. Like, does that make sense?
Sure.
You can't just, I want to buy another property. I have 50 grand for a down payment. You just can't put 50 grand into a tax deferred account. The IRS has limitations. So that's my thought on it. And like I said, it just feels laborious for where I'm at in my stage of life, but someone
Sure.
else might have a different financial model that they're following.
Right. Jeff, what were you going to say? Jeff, are you there? He might be in the mountains.
Yeah.
I see Janelle put in something about health savings account.
Oh, yeah.
I'm not really an expert on those, but it's not a bad idea from what I do know.
I'm very passionate about health savings accounts.
Because you carry it over.
Yes, because
right?
you carry it over. So I'm not covered by my significant other's healthcare, his employer sponsored healthcare coverage. So I have to purchase my healthcare coverage on the marketplace. So I also know that for me personally, this is why I'm saying it makes sense for me and not for everybody else, but I don't have a lot of healthcare costs, and my daughter is covered by our employer sponsored plan. So I'm able to get into a high deductible plan with a health savings account. So the way that it works is I make contributions to my health savings account if I have any medical costs. So if my copays at the doctor, prescriptions, any of that stuff, I can use that account to pay for them. But like Tanya was saying, they roll over. And once you get to a certain balance, you can invest within your health savings account. And as it stands now, those health savings account roll over, and then you should be able to withdraw them at retirement. And the way that I looked at it is if my health costs are $200 to an insurance company for a low deductible plan, and I get a physical once a year, and that's about it for me, right? Then I will have thrown $200 into an insurance company. where if I have a high deductible plan and it costs me $100 a month, and that other $100 I can put into an HSA, and I'm just using easy numbers, that $100 that I put into the HSA, I get that every year. That rolls over and over. If I break my arm while I've got a big balance in my health savings account, should I have a medical emergency? But if I don't have a medical emergency, then I just have more invested money for my future.
Yeah, and I don't have that now because I have a small 401k for my business that I set up through Paychecks, who's like who I use to do my payroll. So you can't do both. So that's why I didn't choose that option. But I would have loved to have done that if I knew then what I know now, because I have my insurance also through the marketplace, and it's really expensive, and I don't go to the doctor very often. So
yeah, it just goes away, right?
So we're running out of time here. We got 4 minutes left. I got one question for each of you ladies here. What is a book that you would recommend for people to read that want to get wiser with their finances? What's one that you've read that you really enjoyed and would highly recommend to others?
I mean, well, there's a lot. Rich Dad, Poor Dad is always a great place to start. If you're, if you feel overwhelmed by maybe your debt burdens, or feel like you can't get your head above water with your finances, then I would reach into the Dave Ramsey library. If you're at a place where you're comfortable with your finances and you just are interested in building more, then I would dip into Kiyosaki with Rich Dad, Poor Dad. And then I like to read Think and Grow Rich once a year, no matter where you are in life.
Right.
Yeah.
Tanya, how about you?
Great. Those are all great. I would just add Profit First. I think that book was really important to me in terms of managing finances for my team, just understanding like it's a profit game. Like if you're not making money or making the kind of money that you should be profiting, there's something broken, right? And being able to put money into those different buckets and things like that. So I like Profit First, and I would recommend that one, as well as the Millionaire Real Estate Agent. Like if you haven't read the financial model in the Millionaire Real Estate Agent book, it's worth taking the time to do that, to know that what the best practices are of the high performing team, the models that they're using to manage their budget and their finances. So I would just add that one as well.
Awesome. I'll give you one more that helps with wealth building, but also with following a budget and things like that. It's a simple read. It's called The Richest Man in Babylon. If you haven't read that book, it's set up like fables, and so each chapter is its own little lesson, and it's an easy read, easy to listen to. If you've got Audible, I think it's like $1.50 on Audible. So
Yeah.
Any other questions? Bless you, Josh.
Oh, I thought I was muted. Thank you.
Well, I want to thank both of you, Maria and Tanya. Thank you so much for giving your time and leading this awesome conversation about finances, and everybody that came and participated. Thank you so much. And if you have other questions about things, I know both of these ladies are very willing to help in whichever ways they can.
Yeah,
Absolutely.
We appreciate
Thank
you.
you. Thank you.
Josh,
bye.
send you
Thanks.
that form.
What's that, Tanya?
I'll be sending those forms to you, and if you get
Cool.
stuck,
I am ready. I'm so ready to fill out some tax